If we look at all the headlines in US, they are harbinger of tough times. Tech layoffs is maximum in last 20 years. Credit card debt is up 15% to almost $1 trillion. Small businesses are unable to pay rent. Cryptocurrency first collapsed. Now crypto exchanges are collapsing. And most businessmen are talking about recession. The Fed, in order to partially control runaway inflation, which is in high single digit, and also to regain credibility, has been raising interest rate at fastest pace than in the history of US Fed. Despite Fed's aggressive tightening, the inflation is fairly stubborn and it's not yet coming down as expected. The one surprising part is that corporate profitability so far has remained reasonably strong. The inflationary cost push corporates have passed on to consumer and maintained their margin. In all this, US government continued to support economy on the fiscal side, and hence public debt continues to rise at a rapid pace. Bond yields, which is a spread between 10-year and 2-year US Treasury, has now become inverted, and it is harbinger of potential US recession in the days to come. If we want to find perfect example for the proverb caught between devil and deep sea, US Fed is the perfect example. If they raise interest rates, then they'll end up creating massive recession. If they don't raise interest rates, they will end up not controlling inflation. Whichever way Fed moves, it requires very, very delicate balancing. One reason why Fed's tightening has not been able to impact inflation so far is because Fed initially maintained reasonably high liquidity. It's only now that liquidity has started coming down at about $95 billion a month. However, when we look at the overall scenario, Fed added $4.8 trillion between subprime crisis to COVID crisis. And what they have taken out is just $400 billion. Clearly, Fed has to go and take out far more liquidity in the days to come. Will Fed keep interest rates higher for longer? The press release of US Fed last time said no, but the press conference of Fed chairman said yes. This walking left, talking right kind of behavior, Fed is intentionally probably doing to keep market and expectations under check. The history does favor the market. Whenever US has raised interest rates to higher levels, it has acted like Mount Everest, where you stay there for a short period of time and not very long period of time. The highest where the Fed rate remained at the top level was prior to subprime crisis of about 63 weeks, which is about a year. But other than that, by and large, Fed has acted like a mountaineer, which goes on to climb Mount Everest, stays there for a while, and then starts descending. This on-off stance of Fed and data about economy has confused investors. By and large, they have remained underweight equities and overweight cash, to ensure that their portfolios don't get impacted in this volatility. The real question is, will inflation decelerate as per expectation? Will inflation fall through the cliff as commodity prices have come down, as consumer demand might get impacted due to fiscal stimulus withdrawal? Or will inflation not decelerate as much because there is still excess liquidity sloshing in the system? I think this will be all a matter of interpretation. And this cartoon clearly says what someone wants to convey versus what someone will interpret. It all depends upon the interpreter. On the global economy side, PPIs have started correcting in almost all countries around the world, especially among Europe. The shipping cost, which is kind of indicator of global trade demand, has now started coming back to pre-COVID level. Like US headline, European headlines are also fairly tough. UK is witnessing double-digit inflation. Many people are forcing to skip meals as they are unable to make both ends meet. Restaurants are going bankrupt at a rate faster than during COVID. The higher energy prices, thanks to the ban on Russian gas imports, has impacted European inflation as well as outlook for real income. Coming to Asia, China has become less and less transparent. Their data disclosure has descended at a rapid pace, making Chinese economy fairly opaque. Long-term investors are staying away from China exposure because of this opaqueness. It doesn't mean that traders wouldn't go to China because of extremely cheap valuation. But we believe that long-term investors will take tactical call on China, but not strategic call on China. Coming to Indian economy, well, probably transformation of this Bansila Pet step well in the city of Hyderabad in Telangana represents what is happening to Indian economy, or where is global economy and where is Indian economy. Pre-90s Indian economy or the global economy today is this Bansila Pet step well before renovation. And today's Indian economy is this renovated step well with all the modern tourism amenities. The world has deteriorated significantly. India is standing out like an oasis in the desert. If you look at headline, many headlines are positive, like railway earnings up 16% year on year, tax collection up 31%, foreign exchange reserves crossing $550 billion after a gap. 97% of mobile used in India today are made in India, compared to just about 8% in 2014. Electricity consumption up 14% in November. However, there are certain worries also. The September quarter earnings were impacted quite badly with inflation. Manufacturing actually degrew in second quarter, which impacted overall growth rate. And trade deficit continues to remain excessively high as exports have come down. We do have chinks in our armor, but compared to the world, we look better. Capacity utilization is now at 17 quarter high, comparable to pre-pandemic levels. Car sales, albeit on a very, very low base, has shown improved performance as supply bottlenecks has been removed. The farm income is expected to grow higher based on good Rabi crop. The rural spend government is increasing, and that should bode well for rural economy. Credit growth for non-food credit, industry, and retail loan is now at a reasonably higher double-digit level. GST collection, 1,40,000 is becoming the norm for almost last 9 months. Our trade deficit continued to remain higher than what we can afford. That's going to put pressure on rupee as well as on growth. Oil as well as non-oil imports continue to remain above our affordability range. One culprit for Indian trade deficit is our trade with China. This year, our imports will cross probably $100 billion, and our trade deficit with China is likely to exceed $87 billion, which is more than our defense budget. One more concern for India is that our recovery in manufacturing sector is fueled by imports. If we calculate the ratio of manufacturing imports divided by manufacturing GVA, the ratio is going higher and higher, indicating import dependence of our country. For India to grow on a sustainable basis, we need exports to accelerate. Our export share as a percentage of globe is very, very low at 1.8%. It's much lower than our global share in GDP, which is roughly about 3.4%. For exports to grow, government has launched production-linked incentive scheme. Production-linked incentive schemes in electronics, mobile phone has worked out well. Will it work out well in other aspects like semiconductor, automobile, solar modules, battery, pharma, etc.? If yes, then exports can bounce back and help improve India's market share in exports and support GDP growth. The second concern for India is that despite inflation coming down, it has remained reasonably well above RBI's comfort level of 6% at the top end of the curve. Clearly, we need to bring inflation further down from current level. While our inflation continues to remain elevated to our objective, it has remained well below American inflation for more than 13 months in a row, which is a feat India has achieved for the first time in its independent history. Partly drop in inflation or subduedness in inflation is driven by energy correction. Oil prices are back to 80s handle. Let's hope and pray that oil continues to fall further rather than bouncing back. The services inflation also has risen as economy has opened up. Tourism, travel are reflecting elevated level of inflation. The good part is that supply can be created. Companies' capex to depreciation ratio for all non-financial listed firms is almost at a historically low level. Clearly, at this point of time, companies have more cash to invest than what they will need. We believe capex cycle seems to have bottomed out between state, central, and corporates. Capex will revive. India is already back office to the world. Our services export market share is almost mid-single digit at 6%, but our goods market share is at 1.8%. We have to transit from being office of the world to manufacturer or factory to the world. If we can achieve that through PLI scheme, then Indian growth for years to come is almost guaranteed. Today, you will notice that we are starting with debt market outlook rather than equity. We believe it is necessary so that people don't forget about debt in this ho-halla about equity. Debt is an important part of individual's portfolio. It brings stability. And we believe over next 1 year, the gap in return differential between debt and equity is unlikely to be wider. It is likely to be far narrower. And hence we are starting with debt outlook first. Globally, it looks like inflation expectations have peaked, and falling commodity prices and withdrawal of liquidity and increasing of rates by global central banks indicate that the trajectory of inflation is now down. The yield curve across global markets has inverted. First time since 2000, inverted curve invariably signals recession. The Fed, as per market expectation, is supposed to raise interest rates by March to April 23 to about 5%. And market is also expecting Fed to start cutting rates somewhere by August to September 23 by 25 basis points. So this year, this time, the interest rate cycle is more likely to be steeply going up and then steeply coming down if inflation permits. From an Indian point of view, our real interest rate is at a reasonable premium to US interest rates, indicating that investors, global investors, may find India more attractive from a debt point of view than American markets. There was mountain of liquidity towards 2018, towards 2021, thanks to record FX flows. Now that liquidity has come down to about 2 lakh crore from as high as 10 lakh crore, thanks to FX intervention and currency CRR increases and increase in currency in circulation. The RBI has managed excess liquidity pretty well during this time frame. At this point of time, we believe 5 to 7 year segment provides better opportunity for investment in fixed income funds. If we talk about the funds, one thing which we have repeated more often, that please ensure that your time horizon and the fund's investment horizon kind of meets each other. If you're looking to park money for a shorter period of time, money market fund, savings fund, and low duration fund will be more appropriate. They all have YTM of 7% plus for investment horizon between 3 months to 1 year. If you're looking at a longer term view, then there are medium term funds like Kotak Corporate Bond Fund, Floating Rate Fund, Short Term Bond Fund, Medium Term Fund, and Banking and PSU Debt Fund, which all have reasonably higher coupon income compared to short term funds. By syncing your investment horizon with the fund's investment horizon, you will be immune or protected against interest rate volatility. Someone who doesn't mind taking a little bit of risk can look at Kotak Dynamic Bond Fund. This fund has also outperformed its benchmark index through deft maneuvering of duration. One other fund which you can look at is Kotak Medium Term Fund. About 63% of investment is in AAA, and rest of the money is in high quality credit instruments. This is one fund where investment horizon is medium term from a portfolio point of view. This fund has delivered reasonably good return in the past, and people who want to take a medium term view on fixed income, Kotak Medium Term Fund will be appropriate. Coming to equity markets, despite 4 rate hikes by Fed this year of about 75 basis points, Indian equity has continued to rise. Now, on 14th of December, there is FOMC meeting. 50 basis point rate hike is almost discounted. What will be critical is Fed stance and commentary. India has delivered almost 4 times more return than MSCI emerging market between 2014 and 2022. If you look at on a 20-year basis, we have delivered about 1.5 times more return than MSCI emerging market peers. India has made money for global investors, unlike most other markets. Partly this performance is driven by our sustained valuation. Historically, we have traded at premium to emerging markets, but right now, the premium of Indian equities over other emerging market is almost high at 139%. This is partly because of massive outperformance of Indian markets over emerging market peers. As our performances improve, our weight in MSCI emerging market has also increased from 7% in 2020 to 14.8% in November 22. While markets are near all-time high, the rally is not broad-based. Only 5% of Sensex stocks are at lifetime high level. That means rest of the stocks are still languishing at lower level despite such rise in Sensex. The other interesting thing about market is participation by your investors. Thanks to mutual fund distributors who took message of SIP to every pin code of India, retail investors now send about 14,000 crore a month for participation in equity mutual funds through SIP. And that has created counterbalance to foreign portfolio investors. Between October 21 to June 22, they sold 256,000 crore worth of Indian equity. Everything was absorbed by your investors through mutual fund. And impact on market was just about 10% down. Between July to November, same foreigners came to buy India. They brought in 83,000 crore and market is already up 19%. We believe domestic investors' participation has created a counterbalance to foreign flows, and more importantly, reduced volatility or the downside of Indian market. We have massively outperformed China. Over the last 30 years, Chinese MSCI Emerging Market Index has not delivered any good return. Compared to that, India has grown by leaps and bounds. We believe in the near term, some investors may shift money to China on technical basis because of the very, very cheap valuation and potential opening up of Chinese economy. On the longer term, we believe India will be preferred by global investors because this is the country where rule of law, democracy is visible, and global investors can take longer term call of becoming investor in India rather than technical call of becoming trader in China. From a valuation point of view, Indian equity provides an interesting observation. Next slide, please. Currently, we are trading at a marginal premium to our historical average. Average historical P is 18.5. We are trading at about 20 times. The price to book historically is about 2.6. Currently, we are trading at about 3.2. Undoubtedly, from a valuation point of view, we are somewhere near our historical average. The same thing looked from market cap to GDP ratio. We are now trading at a reasonable premium to our long-term average. India has traded about 79% market cap to GDP ratio. Today it is 110%. That means my market is valued at a higher rate, higher level than my entire GDP. Generally, this indicator suggests that you should be looking to book profit on excess positions in equity. If we look at equity market vis-a-vis bond, undoubtedly equity markets look expensive, and which is where we started with debt market outlook to re-emphasize this point. On a next 1 year basis, the gap between equity and debt is likely to narrow down substantially. If we look at Q3 FY23 results, they have come generally in line with expectations. However, the results clearly show the hit by inflation. If you look at this data of quarterly results summary, our EBITDA margin for September 22 quarter at 18.7 is substantially lower than what we witnessed during March 20 quarter or any period thereafter. While the sales and EBITDA and PAT has continued to grow, it is a margin which reflects the hit of inflation. If we look at foreigners' flow into Indian equity, they did sell between October 21 to June 22, but post July 22, they have emerged as a net buyer in Indian equity market. If I have to summarize outlook for 2023, well, it's likely to be a volatile year with a roller coaster ride, and hence having allocation between debt, equity, real estate, commodity is extremely important. This is not the time to be over leveraged in equity. This is not the time to be leveraged in equity. This is the time to maintain neutral allocation to equity and use any correction as an opportunity to enter. Our call remains same as in mid-2021. marginal overweight large cap, marginal underweight small and mid cap, and equal allocation to equities as an asset class. This is buy on dip market. Whenever you get an opportunity of a correction, try to grab it with both the hands to add to your equity portfolio. At this point of time, it is worth recommending investors either they come via SIP or they come via STP, but having longer term time horizon. Our funds continue to beat their benchmark. There are few funds where performance vis-a-vis benchmark has not resulted into positive alpha, but that is partially due to certain stocks which we are not owning because of governance concern or valuations concern, which are there in the index. Our hybrid funds continue to do extremely well, whether it's debt hybrid scheme or multi-asset allocator. They all continue to do well with double-digit return and, more importantly, positive alpha. We have talked about tortoise and hare fund. In all those funds, the upside downside ratio is in favor of investors. Through dynamic asset allocation, we ensure that there is higher upside participation and lower downside participation across our bouquet of hybrid funds or fund of funds like Kotak Debt Hybrid, Kotak Equity Savings, Kotak Multi-Asset Allocator Fund of Fund Dynamic, and Kotak Balance Advantage Fund. This is the season of tax saving. A lot of investors will be applying for their annual tax savings in equity-linked savings schemes. Over here, Kotak Tax Saver Fund will provide a good opportunity. All those people who are listening on this call, please ensure that your tax saving is done via Kotak Tax Saver Fund. If I have got your money and I can satisfy you with investment experience, I'm sure you will offer it to your customers. Our flagship fund, Kotak Flexi Cap, went through a deteriorated performance for a while. There were many questions and we tried to explain multiple times that it is the portfolio which generates future return. We are very confident about our process and our bets will eventually take off. Fortunately, now those arguments seems to be coming correct. The fund has started outperforming its benchmark as well as its peer group. Crypto assets continue to suffer downfall. FTX saga impacted crypto valuations across the world, and from somewhere around 2.26 trillion valuation, crypto has declined to 833 and falling further. %78 of Bitcoin units haven't transacted in last 6 months. It shows illiquidity of crypto assets. In some sense, what goes up must come down. In the 80s, gold prices went up and corrected. In the 90s, Nikkei and Thailand stock market went up and then corrected. 2000, all of us knew TMT bubble. If we look at the past, the current Bitcoin rally is standing out like a sore thumb. Undoubtedly, Bitcoin prices and other crypto assets have started correcting, but there is probably still some more downside. One more investment option which one can consider is buying of gold. Gold hasn't done well in this pandemic time. From about $1,600, it went to $2,100 before coming back to $1,800. The central bank demand for gold seems to have increased. Most analysts believe it is Chinese central bank which is buying gold. China can have huge appetite for gold. It can take away supply available, whatever is the supply available in gold. And if that happens, gold prices can certainly rise from current level. Gold has an inverse correlation with Fed. When US interest rates are going up, gold prices starts coming down. And when US interest rates are falling, gold prices starts moving up. Hopefully, we are nearing Fed's tightening cycle, and hence gold prices have remained subdued. Whenever Fed comes to easing mode, which is somewhere around fourth quarter of calendar year 2023, as per market expectation, then gold prices can start moving up. The other interesting thing is related to silver, which has also dropped massively in last about 2 years. Based on this pattern, it looks like silver is making a bottom after a period of about 2 decades.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.